Okay, so this is the Rank Without Banks panel. Our moderator apparently is still in another panel, so we're going to start without them and let them walk in on it.
It's going to be
so go ahead and introduce yourselves.
Hey guys, so my name's Nadav Hollander. I am the founder and CEO of a company called Dharma Labs. We are building something called Dharma Protocol, which is a globally available and decentralized peer-to-peer lending platform for cryptocurrencies. And yeah, I'm excited to chat about that and decentralized banking in general.
Hey guys, my name is Stani Kulechov. I'm the CEO and founder of Aave, which is behind of Etlend. Well, Etlend, maybe that's the American pronunciation. Basically, we provide a marketplace for crypto-backed loans, and we have been operating this for a couple of years now on mainnet. And yeah, excited to be here.
Hello, my name is Caleb Slade. I'm a co-founder and chief knowledge officer for Salt, based here in Denver. We are also doing blockchain-backed loans. We're doing US dollar denominated principals, deposits straight into your bank account, backed by Bitcoin, Ethereum, Dogecoin, and Litecoin, and most recently USDC. So excited to be on the panel and talk with you guys. What do you guys think we should talk about first? It's very decentralized, disorganized, but still effective.
Well, maybe we should take audience questions first. And
Yeah,
see if
that's
there's
a great
anybody
question.
that has any questions while we await our moderator.
Yeah. Anybody have a question?
Yes. Okay, so I'm going to repeat the question so people hear it. So the question was, are there any regulatory regimes that we are worried about, in particular in the US, that are either bottlenecks or blockers for mainstream adoption of crypto-backed lending? I will kick it off as to the rest of the gang first.
Definitely. When you're lending in the U.S. states, as a U.S.-based entity especially, but really if you're any entity lending to U.S. Consumers, most states, it's a state-by-state individual licensing process. It's very frictioned, it's very difficult, and takes a lot of time and money. But if you want to go about it right and you want to keep yourself and your customers safe and your company safe, you just have to go through that process. So.
Yeah, I think the whole regulation is interesting question. Yeah, basically, am I worried about regulation? Yes, I mean, especially in the US. I mean, things are pretty over-regulated here compared to where I come from Finland. But I think like in kind of every model, we need to think about regulation, but when we are thinking of like trustless systems and decentralization, it's where the collision comes in. In one way, you need to basically think what laws apply and who is responsible of, let's say, if you deploy smart contracts which are based on depth. And on the other hand, some of the decentralization kind of like mechanics behind are kind of colliding with law as well and regulation. And but I would say it's a very difficult thing. There's a lot of gray area when it comes to cryptocurrencies and blockchain technology, but it's very difficult field to operate. And I think for the next couple of years, that will be very interesting question when we have decentralized systems, for example, DEXs and who is responsible there, or when you initiate debt. So I would definitely agree that regulation is something that we're worried about and a bit of scared as well.
So a common denominator for the way lending is structured for a lot, if not, I believe all of us, is that there generally tends to be a fairly peer-to-peer component to how the loans are structured. Like there's somebody investing in the loan and then somebody borrowing it. And I think it's important to note that like it is legal and compliant. There are legal and compliant ways to do peer-to-peer lending in America. There are many peer-to-peer lending businesses. This has been a wave that has come and gone already of like kind of like companies starting peer-to-peer lending businesses. And so it's not something that's explicitly like there are explicit blockers to. It's just there's a lot of friction to actually getting there. And in particular, there's a lot of friction if you want to kind of provide, if you want to adhere to these sort of values of open accessibility for everybody on both sides of the market. That's where things get really, really difficult. Because in particular in the US, we have a lot of very stringent investor protection laws that generally put a lot of constraints on the degree to which you can allow retail consumers to invest in loans. Now, this is an immensely complicated subject. This is like, there is not a one-line response to any of these questions. And it's super case by case on the basis of what you're doing and how you're doing it and what assets are being traded and all that whatnot. But the main sentiment that I would communicate is that there isn't an explicit blocker per se, but the sort of utopic vision of like anybody can access the market without any hindrance is likely to not fully pan out, at the very least in the US.
Yeah, I mean, I think what we're seeing is really just, it's indicative of such a new technology that doesn't fit the same paradigms and the same structures that we're familiar with, or at least our regulators are familiar with. So we do have this like two tidal waves hitting into each other, where you have both the SEC and then you have state regulators, all like, there's just hundreds and hundreds and hundreds of individual regulatory agencies in the US, and they're all wrestling with how do they kind of push a square peg through a round hole. And it's been a little messy and it's slow. That's kind of the par for the course with regulatory changes. It happens very slowly. But the technology is not going to stop innovating. So I think you're going to see a lot more movement and pushback from the more like on-chain decentralized contract-driven lending instruments where you do have individual peers funding other individuals' debt in a very decentralized fashion. It's really exciting for us. We really want to help do anything that we can to bring this to the forefront as well, because it will impact our business, we believe, in a very positive manner. But until that time, it's really just from Salt's perspective, we want to take a very active and engaged perspective with regulators and help them come along and help them understand the upside of regulating this in a better way than a worse way.
Maybe I could add also, if you think about like Edland or even like the stuff I have read about Dharma, basically that kind of it's a basis of decentralized finance, which basically means open permissionless system that is censorship resistant. Now, if you put this thing like together and think how it fits into regulation, it just doesn't fit, right? It's kind of like very difficult to try to put something this kind of novelty to something that we have that just Caleb said that it's so new technology and the whole aspect that we don't know how to handle it. And I think that might be even a bit of perspective that the regulator might need to consider a bit as well. But nevertheless, I mean, laws, regulation are there to protect some interest and some stakeholders. And for example, when we are running even decentralized systems or smart contract-based systems, like, for example, Edland, we need to always think the end user. I mean, what kind of risks the end user is going, I mean, or should we even advise, educate the user, or what happens if the user loses its key? And there's so many things we need to consider, and if those things are not handled, it might be that we will not get much more adoption that we are getting at this point.
And I think also, one of the things that will really drive this space as a whole is really an injection of capital. And anything that we can do to facilitate as much capital coming in to build up the credit availability and the credit layer globally is going to help push this space forward. And the reality is, if you look at Prospers and SoFi's and a lot of these, what you would consider peer-to-peer lending platforms, a majority of their capital isn't actually coming from peers, it's coming from institutions that are lending into this, institutional lenders who are bringing the capital to the Prospers and the SoFi's and lending trees, et cetera. And what they're waiting for, these institutions, is this regulatory framework so that they can both protect their shareholders and that they can remain compliant, because otherwise they won't put their capital into it. So and I think that the sound regulation, if it comes, will come a lot from pressure from the traditional financial institution, who really are just waiting on the sidelines, waiting to jump into this, because they're not just stuck to the dollar like a lot of people think they are. They're in the money business, not the fiat business, right? And they want to provide a product to their customers that's of value, and they're going to follow their customers and their demand. So I think that's probably where most of the force is going to come.
Just as another note on this front, and then we could probably transition to another topic because we've been beating this reg horse dead. And it also looks like our moderator, an additional panelist, has arrived, and so this nice intro period is coming to an end. As a last point, I think that there's a distinction between the protocol layer, or rather the contract layer, and the application layer being like open, permissionless, and accessible to everybody. And what I mean by this is that is that you can have an application that leverages TCP/IP in order to deliver packets to whoever, and those packets can contain the bits and pieces of an application that is legal or illegal. But at the end of the day, anybody can use TCP/IP, and that's what's powerful about it. And I think that as technologists designing systems for this, idyllic future financial system, I think we ought to prioritize openness at the level of the infrastructure, where if you are technical and you want to use these pipes and rails, nothing stops you from doing that. But where I do think it makes sense for regulation to come into play, or at the very least, a consideration of compliance, is at the application layer. If you are actually facing users and you're using the pipes to deliver products to people, you have a certain responsibility to comply by the regulations that govern those users' interactions.
Get some new people.
Hi, I'm Kyle Kistner. I'm co-founder of BZX Network. I'm moderator of the panel. I was on another panel, kind of ran over a little bit, but I'm here now, so hello everyone.
Hello everyone, my name is Alex Bajano. I am CTO and co-founder of Blockboard, and we are doing the digital asset lending platform that allows you to interact with all of the open lending protocols on Ethereum blockchain. And it's the only place that you need to interact with in order to decide on loan terms or take a loan on those protocols.
So if I could just ask you guys, what have you talked about so far? Have you talked about your... Okay, question about regulation. All right, so go ahead and let's go around and talk about what's your vision for DeFi 2019? How do you see your projects reaching mainstream users? How do you see it interfacing with institutional users? And what role does your project play in the ecosystem? So start with you.
So SALT really is, one, we are paying really close attention to all the layer one protocols like Dharma Protocol and etc. and ETHLend. We think that that's absolutely vital, but where we're really focused is more on the layer two or layer three on-ramps and off-ramps for those major injections of capital, for the institutions to be able to join this new ecosystem, and for consumers, both existing blockchain users as well as for new people who aren't like a part of this blockchain community, to have these very easy, lubricated paths to join this ecosystem and have access to these financial services.
Yeah, I think in terms of the adoption in ETHLend, basically what we have thought about in Aave for the past couple of years is basically we have trying to build more features, more ways to borrow more assets. But one thing we realized in the whole mainstream adoption is kind of like decentralized finance is a ecosystem game. So I think, and a bit of UX game as well. But I think the more DeFi works together, when ETHLend can work together more with Dharma, Blockboard, Kyber, MakerDAO, and we all basically love each other, we're happy, and we're providing more users to each other and getting more people into the mainstream. Kind of like our decentralized ecosystem. I think then we grow together. So I think the kind of issue, and guys like Salt, of course, focusing on gateways, provide more users as well for the cryptocurrencies, and then from that to DeFi. And I think that's one of the biggest things the whole eDenver is all about. People building things, small things, and we connect the small things to achieve bigger things. And then the second thing is the UX game. I mean, our UX sucks. We all know it. I mean, the whole DeFi UX sucks, but we have done a lot of work on that. All of the projects out there. I mean, I think there's an audience, a couple of users who have used our application 2 years ago, and it was completely unpleasant. But we have worked. We have put a lot of work into the UX, and a lot of projects has done that as well. And I think that's a big part of the whole accessibility that basically, if we are as easy to use as, for example, centralized systems, then we can compete. I think so.
Yeah, so I'll first of all echo all the points that have been made. I think that onboarding the institutional class of investors into this new asset class is a huge deal. I think that the way in which these various DeFi primitives like start to get jumbled up together and recombinated and kind of mixed up in interesting new ways is fantastic for growth. And again, like I also agree that UX is probably the #1 thing that needs to be worked on right now. Honestly, even more than things like scalability, particularly for things like lending, where you don't necessarily care as much about a high throughput. All you care about is like whether the gas fee for deploying this contract is going to be like sufficiently low to make the transaction profitable. As for mainstream consumer adoption, I'm going to be honest. I don't think that's going to be happening in 2019. I think that's not the market for crypto lending right now, and it won't be for a good amount of time. I don't know what that time horizon is. The reason being that at the end of the day, right now, the use cases for cryptocurrencies, like the most useful thing that you can do with a cryptocurrency is buy or sell to another cryptocurrency. Like that is the thing that everybody uses cryptocurrencies for, is trading. And so until that barrier gets crossed and it's easy to use DAI to buy something on Amazon or even at my local market, I presume that the use cases for, at the very least, like crypto-backed, like smart contract-based lending will be largely speculative. With that being said, though, we're getting really close. Like, I mean, if you guys have tried the Buffetcorn burner wallet interface for using your DAI to pay for the food here, I mean, it's incredible. It's seamless. And I think like these things move very quickly, and as soon as cryptocurrencies like DAI become usable by normal consumers, that opens up a whole new ballgame for what decentralized banking and lending technologies can be used for.
All right, thanks. Yeah, I agree with the guys that the user experience was the biggest problem back in the days. And right now we did a lot of stuff to increase the usability of our applications. And right now, we need to bring more liquidity to our market because we are not competitors with each other, because the market will be so big that there will be a lot of use cases, and all of us will be catering to some specific use cases. So, but we can't grow faster than the market itself. And right now, the only the couple of use cases is like borrowing, lending. I mean, like borrowing just for doing short, long positions, just to have a working capital for exchanges. So it's not a really big market, and we can't do anything else if we have loans backed by crypto loans backed by other crypto. So I think the next direction that we need to explore is the tokenization of different types of physical and intellectual assets from the real world, and it will allow us to bring much more use cases to our platforms. For example, if we have the tokenized debt backed by tokenized physical or intellectual property or by company shares, we can make this market drastically bigger than today, and it will solve other problems. It's not so big as the use cases and the market and liquidity that we have nowadays, in my opinion.
So
I wanted to add something to that really quickly. That's a fantastic point about the new sorts of assets that are going to come to market. I think a really big trend that may actually come sooner than anything related to like DAI or like stable coins being usable in the mainstream is synthetic assets that replicate things like the S&P 500 or something like that. So there's a lot of awesome projects that are starting to bring this into production, where you basically just like have two counterparties put up a bunch of collateral, and then you just kind of create this asset that like tracks the S&P 500, and anybody in the world can use it. You don't need to be a U.S. citizen or anything. Like it's just a token. That's a pretty wild prospect, because all of a sudden that introduces this idea of like, let's just replicate all of the asset classes that we have in the existing financial system and just create them in this permissionless context where it's really easy to frictionlessly trade them. And then that just opens up an entire new field for what projects like ours do in terms of things that you can borrow against or lend out.
So I think Nadav raised a really good point there about mainstream adoption being a whiles off. So I wanted to ask, forget about the mainstream. Where do you see adoption of DeFi by crypto users themselves happening? Because there's two big problems. It's one, you need crypto users to adopt, and two, you need to onboard the pool of crypto. You need to make the pool of crypto users larger. That'll get the mainstream on. So mainstream adoption is more about crypto adoption. DeFi's big problem is getting its own crypto native users actually using it, instead of all of the centralized stuff or just ignoring projects altogether. So what do you see the root is to getting adoption within our own communities? And second, just a related question, what are your views on decentralization versus user experience, and how that might relate to getting our own decentralization value and community buying into the products we've already built?
So I think one of the big things standing in the way, like Nadav said, is the utility that is available when you hold a crypto asset, right? You can either buy or sell. You can either transact it or not transact it. And in a lot of ways, being able to leverage something is a utility. So when people ask, what can you do with Bitcoin? Being able to leverage it for cash or for some other cryptocurrency, and as the other projects are doing, that's a really serious utility. If you look at like the housing market, one of the reasons that it's grown so dramatically over time is because of the utility of being able to borrow against the equity that you put into your home. A lot of people would not buy a home if they did not know that they couldn't borrow against that equity that they put into it. So for us, being able to give people the currency that they need to spend today, which is still fiat currency. Your bills are still going to be in fiat currency because MicroDAI isn't accepted everywhere. This is a huge gateway to not only drive utility for the token, but also to drive adoption for new people to come into the space. Because if you think about your parents with a $40,000 Charles Schwab investment account, they're going to be much more likely to put $20,000 into cryptocurrency if they can instantly leverage that and pull out, $10,000 to $15,000 in cash and hold that into their bank account, because that's what they're familiar with. It's like buying any other asset, like a stock portfolio, that they can actually leverage for cash. So for us, we think the ability to leverage these assets is absolutely a huge driver for adoption for both existing crypto users and new crypto users coming into the space.
Yeah, and I think basically as a kind of decentralized platform, smart contract based, the kind of issue, of course, is we have similar issue as DEXs usually have. So basically we have this big liquid exchanges around, for example, like Binance, and then we have DEXs, which are getting more easier to use, but people are still using centralized providers. So kind of like we have the similar thing with the UX, and like we're competing with the centralized providers. So like, I mean, every day I wake up, I'm thinking like how I can compete with Salt, and thinking like how I can steal customers from Salt, and basically, I mean, we are competitors in one way, but kind of like my stuff is more like decentralized, smart contract based, and kind of like what I'm trying to do is teach like the cryptocurrency users and the customers of Salt, like what benefits they could have from using our technology. And I think what we can learn from like centralized systems and service providers is like they're so easy to use, but we could be easier as well. I mean, it's just like we need to improve things, and we should never forget that centralized exchanges, centralized lenders, they are actually a gateway for people into the crypto pool. And there's basically where we are kind of like competing for the users. So kind of like we are in some way piggybacking of each other all the time. And I think that's totally cool. But yeah, that's one thing. I mean, the whole being as easy as you guys are, and being as secure as like our platform is. Yeah.
Yeah, I mean, I think the way that we look about it is like, yeah, we're all competitors in one way or another, kind of. But we see it more as we are all competing against this ideal lending experience for the users. And that's really what we're all striving for. And if we really get focused on how to stop the other people from growing, it's not going to help us or our users or the space as a whole. So really, we're excited for the decentralized, the DeFi, the on-chain transactions to get developed to the point where we can plug them in to the systems that we have that are, you know, more centralized, more user experience driven, and have everybody benefit from them. You know, absolutely, good sentiment.
Yeah, I totally agree, and I think it's kind of like I would not say, I mean, you can't be all kind of like thinking like you will be only like decentralized. I mean, sometimes I think you guys also think about smart contracts. I mean, you have some custody smart contract base, so it's not like there's centralized bad guy and decentralized good guy. It's actually like how we work together, and I definitely want to see more work together in lending space. So that's what the whole ecosystem approach is.
So I think there's like this false dichotomy that people have often, where they think about like, okay, either I'm going to use a centralized exchange or a centralized margin provider or what have you, or a centralized working capital provider, whatever, and I'm going to have an easier experience there, or I'm going to compromise on the experience in order to have this decentralized experience because I'm more either ideologically aligned with it or because I care about things like counterparty risk. I think that's going to go away. I really do. I think that there are aspects of the decentralized exchange user experience that are actually significantly more convenient than the kind of the centralized exchange experience. And I'll list a couple. So we all know that using things like MetaMask and things like that are hard. So that's a big con of using decentralized systems, having to worry about gas and all of that whatnot. But on the flip side, if I want to go and buy ETH with DAI, I have two options, right? I can go onto like Hit BTC or one of these centralized exchanges. I can take the first step where I transfer my assets in. I wait about an hour for depending on the asset. I wait, let's just say 10 minutes for the sufficient number of confirmations to have happened such that that platform is willing to trust that they now have my assets. Then I execute my trade. Then I want to go and pull the actual asset out, which often has some sort of withdrawal fee or has some sort of limits to it or all sorts of whatnot. And then finally, at the end of this whole process, call it 30 minutes to an hour later, I now actually have like the asset in my personal wallet, and I'm ready to do whatever I want to do with it. And if you look at the decentralized systems that exist, you actually don't have this issue, right? Like you can go to Radar Relay right now, and you can instantly execute a trade directly from your wallet without even having an account on there. And so why am I talking about decentralized exchange when we're talking about things like decentralized lending? It's because I view them as being very analogous, like in terms of their value props compared to their centralized alternatives. Like using something like Dharma or ETHLend, you can actually go and basically with virtually instant settlement take out a loan that is collateralized with minimal counterparty risk. That's really, really powerful. And though it may be a kind of janky experience right now, I think that's going to change very, very quickly.
Yeah, all right. Yeah, so yeah, I agree with Nadav that we just need to remember the pros of the decentralized applications. That, for example, if we can go for example, to Blockboard, take a loan, and then we can open the Radar Relay or some other DEX in another tab in your browser, and you don't need to wait to withdraw money from Blockboard and to to place the money to some DEX. You can just switch tabs and do whatever you want like instantly. And that's the great value proposition for users. And we just need to spread the like different use cases across. I mean, like we need to allow more use cases with our cryptocurrencies that we own right now, because like I can't do a lot of things with cryptocurrency, and that's probably the main blocker for the adoption, for like bringing more users to the space. So, for example, if I will be able to buy like food in my like supermarket with cryptocurrency, or I will be able to buy a car or a house with the crypto, it will be like easier for me to transfer like all my financial like activities to this sphere. And I think we just need to enable more use cases, and organically we will have more like users flowing into our ecosystem. Yeah.
All right. Thank you, everyone. We're kind of running out of time here on the panel, so about to wrap it up. So thank you, everybody, for talking and sharing your thoughts, and hope to, I don't know. Thank you, guys.